In January of 2026, the financial world did something it doesn't do very often. It stopped scrolling. Capital One, the bank that spent decades asking,
"What's in your wallet?"
answered its own question with a $5.15 billion check. The recipient wasn't another bank. It wasn't a payment processor. It was a Silicon Valley FinTech called Brex. Now, on the surface, this looks familiar. A big bank buys a smaller tech company. End of story. But if you zoom out just a little, something doesn't add up. Brex was once valued north of $12 billion. This wasn't a victory lap IPO. This was a haircut, a deep one. And yet, Capital One still paid over $5 billion for Brex. So why would a 30-year-old bank buy a startup at half its former valuation? What did Capital One see that the public markets didn't? I'm Jeff Galak, and today we're going to break down the Capital One acquisition of Brex and what it means for the banking industry and for consumers. Here's the key idea for today. This deal only makes sense if you stop thinking about banks as banks and start thinking about them as software systems. But to understand why Capital One bought Brex, you first have to understand something deceptively simple: how a credit card actually works. Let's rewind all the way back to 1949. A businessman named Frank McNamara is out to dinner at Major's Capital Grill in New York City. The check arrives and he realizes he's forgotten his wallet. Total nightmare. Now his wife winds up bailing him out, but that embarrassment sparks an idea. McNamara creates the Diners Club card, a piece of cardboard that essentially says, "Trust me, I'll pay later." Merchants accept it, and the Diners Club sends you a bill at the end of the month. This was the birth of what's called a closed-loop payment system. One company handled the customer, the merchant, and the billing. Simple. But then, in 1958, Bank of America changed everything. They launched the Bank AmeriCard, what we now know as Visa. And they did something almost unthinkable today. They mailed 60,000 live credit cards to random people in Fresno, California, just to see what would happen. This so-called Fresno drop led to chaos, fraud, confusion, but also scale. Out of that experiment comes the four-party model that quietly runs your daily life. There's you, the cardholder, there's the merchant, the store, there's the issuer, your bank, there's the acquirer, the merchant's bank, and then there's the network that sits behind all of this: Visa, MasterCard, Discover, the invisible rails moving money between everyone. For decades, banks were perfectly happy living inside this model. They issued cards, they earned interest, and they paid networks a small toll for using the rails. But Capital One CEO Richard Fairbank has never been comfortable renting infrastructure. Before we dig into that, if you find this kind of breakdown useful, please take a second to like this video and hit the subscribe button, as that really helps the channel and lets me keep making videos for you. Now, back to Richard Fairbank and his new way of thinking about banking. In May of 2025, Capital One completed a massive $35 billion merger with Discover. And with that single move, Capital One stopped being just an issuer, they became a network. They didn't just ride the rails anymore, they owned them. So here's the puzzle. If Capital One already owned the rails, why did they still need Brex? Well, most large banks are haunted by a dragon they don't like to talk about: COBOL. It's a programming language from the 1950s that still runs the core systems of many global banks today. These systems are monolithic. Huge, fragile blocks of code where changing one thing risks breaking everything. Trying to innovate on top of that is like trying to run Tesla autopilot software on a 1980s Game Boy. Capital One is the exception. In 2020, they became the first major US bank to move entirely onto the public cloud. That gave them speed, flexibility, and modern infrastructure. But infrastructure alone doesn't give you intelligence. That's where Brex comes in. Brex was founded in 2017 by Pedro Franceschi and Henrique Dubregas, two Brazilian entrepreneurs who noticed something broken. Startups couldn't get corporate credit cards because banks only looked at FICO scores. But startups don't have FICO scores. They have cash flow. Brex flipped the model. They underwrote businesses based on real-time financial data, not static credit histories. But here's what most people missed. The card wasn't the product. The product was software. Brex quietly built an AI-native financial operating system. Expense management, payments, compliance, and accounting, all talking to each other in real time. And just days before the acquisition, Brex released an AI-native accounting API designed to automate one of the most painful processes in business, the month-end close. This is the moment the deal clicks. Capital One didn't buy a FinTech card company, they bought an AI brain. A brain that could sit on top of their newly owned Discover rails and finally turn a bank into something closer to a software platform. Richard Fairbank is betting that it's cheaper to buy intelligence than to teach legacy systems how to think. But why did this all happen now? Why didn't Brex just wait it out and go public? 2 words: FinTech winter. High interest rates dried up easy capital. Investors stopped rewarding growth at all costs. Suddenly, profitability mattered again. Brex's valuation reset from 12 billion to 5 and change. Capital One didn't see a fallen unicorn. They saw a discount on infrastructure. And there's another clock ticking: regulation. By late 2025, discussions emerged around capping credit card interest rates at around 10%. For banks that rely heavily on interest income, that's an existential threat. But software doesn't care about interest rate caps. With Brex, Capital One isn't just earning money on lending, they're earning it on subscriptions, transaction software, and business workflows. It's a hedge against a very different future. So what does this mean for you, the consumer? First, agentic banking. Capital One is moving towards AI agents that don't just show you your balance, they act on your behalf, canceling unwanted subscriptions, flagging wasteful spending, and negotiating bills. Second, credit access for the gig economy. By underwriting debt based on cash flow instead of FICO scores, Capital One can finally offer credit to freelancers that traditional banks ignored. But as always, there's a catch: consolidated surveillance. Capital One now sees consumer spending through Discover and corporate spending through Brex. That's unprecedented visibility into the economy, and who knows what they'll do with that information. For years, we've been told that FinTech would kill the banks. But this deal tells a very different story. Banks aren't dying, they're consolidating. They're absorbing, and they're evolving into software sovereigns. With Discover, Capital One owns the rails. With Brex, they own the brain. And with customers, they own the relationship. This wasn't just an acquisition. It was a blueprint for what every surviving bank will have to become in 2026 and beyond. Again, I'm Jeff Galak, and I'll see you in the next one.